Hey everybody, James Nutter here from I Am Wealth. Did you know that 3 of every 4 American families say money is their number one household stress? That means 3 of every 4 of your friends say money is their number one household stress. I too have felt it. I imagine you have felt it. Otherwise, you wouldn't be here right now. So that's why we created the I Am Masterclass, a safe space for you to learn with your friends and families how to take control of your money without making critical mistakes. And so thank you so much for being here. And please visit us at iamwealth.com. We offer free financial wellness diagnostics, have a bunch of great resources on there for you. And without further ado, let's jump into the masterclass.
Let's just get this thing rocking and rolling, and people show up, great. If not, you guys get like a one-on-one with all 3 of us, which would be awesome for everybody. We'd love all of that. So welcome to another I Am Wealth Masterclass. We call it the A Life Well Lived, a Physician's Guide to Wealth Masterclass, brought to you by I Am Wealth. I'll be your host, James Nutter, partner and financial planner from I Am Wealth. And welcome, and just thank you again so much for being here and investing your precious time. I know there's a zillion other places you could be, although you're down in Florida right now. Likely most of you are down south, and it's probably pretty hot. So it's probably like winter for us up here in Michigan. Lots of hibernating going on. I'd like to just start with a few, thought-provoking questions and get a little vulnerable myself. So, who here has ever felt overwhelmed, uncertain, insecure, or lacking freedom as it relates to money? My head game, or my hand is in the air, and yes, I've played head games, and I can play a lot of head games as a financial advisor. And who here has ever felt uncertain submitting their taxes? Did I do it right? Is my CPA being too aggressive? Is my CPA not being aggressive enough? Can I trust TurboTax? Am I paying too much? Do I have the right CPA? When is the right time to find a CPA? My hand also up in the air. I've gone through all of this myself.
Do you dislike all CPAs?
What do you say?
I said, do you dislike all CPAs? I'm just kidding.
Yeah, exactly. All financial planners, yes. No, I'm just kidding. So the nice thing is a 1099, you have, kind of creative control over your own destiny, just as like Jeff and I now have as entrepreneurs and owners of I Am Wealth. And then one other fun thing is, or not so fun thing is, who here has ever been just on a high on life, feeling good, like good vibes, and then all of a sudden you get that letter in the mail from the IRS and your stomach just drops and your heart starts blah, 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 blah. Yep, I got one of those last fall. It was a great time. My CPA, it wasn't Matt, Matt's the man, messed up my personal taxes in 2021. I got a bill for $4,000 last fall. So that was a lot of fun. So anyways, yeah, me too. And I do this for a living, right? So you aren't alone. And I was name the problem. 3/4 of all American families say money is their number one household stress. Year after year, physician burnout stays steady at about 42%. A lot of that is caused, of course, by your job and the day-to-day and everything that comes with it. But a lot of it too relates to money, lifestyle, not having enough time, all things that also relate to, what we can do to help families. And then a couple of more interesting stats is TD Ameritrade reported that 41% of divorced Gen Xers and 29% of divorced baby boomers state that the reason their marriages ended was due to financial disagreements. Ouch. So anyways, I'll be curious to see, for my generation, the millennials, what that looks like in the future. A little bit spooky. And then add to this, a CNBC did a study that found 54% of people believe a partner with debt is a reason to consider divorce. Once again, that's all the whole human population. That's not just physicians, but once again, really, really interesting stat, especially with the amount of med school loans and things like that. So there's zero kind of real world money education in the world. If you Google or ask ChatGPT what to do with your money as a physician, it's going to spit out a bunch of cookie cutter solutions like live like a resident or follow this crazy algorithm or formula to financial success. And of course, we all live in the current Instagram economy where we're constantly keeping up with the Joneses and comparing and contrasting and judging one another constantly. So all of this is the reason why we created the I Am Wealth Masterclass, just a safe space to learn about money and how to make healthy financial decisions as family, and in doing so, living meaningful lives. And just a little bit about I Am Wealth. We're a fiduciary financial practice. We currently help about 91 physician and affluent families, and I believe we're up into the mid-70s for total physicians that we work for. And then for all others, we just love giving away a ton of value like this, hopefully better than some online paid 12 step, 12-week program that you could buy to financial success or whatever it might be, doing things like this for free. And of course, this is for two reasons. One, to just provide real world financial wellness that you deserve. And then two, hopefully earn your trust. And maybe if something that we do helps you out, you can reach out someday and learn more about us and what it looks like to actually become a member and help you guys take it to that next level. And for everyone who registered, just to reward your proactivity, we offer free financial wellness diagnostics to help you assess the current state of your financial health. We'll have your emails. You get all of our free resources, all future invites to future master classes. Of course, you can unsubscribe at any point in time. I totally get a lot of emails. And then also I have a show that has 2 episodes a week on the Financial Residency podcast, and you can find that on Apple and Spotify. A few quick ground rules, and then I'll pass off the baton here that I have to cover. Is we commit to no cost for these, as you know, no sales. We're not going to talk about any individual products, no mutual funds, nothing like that, no individual stocks. And because of rule 1 and 2, no bull. And you can use your wildest imagination for what that means. There's a lot of fluff out there, a lot of wine and dine, take physicians to dinner and try to sell you something, right? We're not doing any of that here. We don't have time for that. And as a disclaimer, I Am Wealth does not offer individual financial advice outside of a formal fiduciary consulting agreement. Content discussed in this masterclass is not and does not represent any financial, tax, and/or legal advice. The intent of the I Am Masterclass is to provide extremely valuable educational content for free. And for personal questions, we hope you'll visit iamwealth.com to see how we can help you and your family take control of your money. Book one of those free financial wellness diagnostics. You can email journey@iamwealth if you have ideas for future topics you'd like us to cover. And the cool thing about this, we did one of these back in the spring where Matt joined us. Today is going to be focused solely on business entity and business structure. And then we're going to be doing another webinar the 10th of July, specifically geared towards physicians of ERG, focused on deduction mistakes that you don't know that you're missing and or making. So that's going to be a lot more deduction focused. Today's going to be a lot more focused on S Corp versus LLC, how to structure everything. And just to introduce the other 2 lovely gentlemen I'm with today. For those of you who know Jason Bunce, who's a physician at ERG, Jeff and him once upon a time were physicians, meatheads, and played football together at Michigan State. I think Jeff was kind of a stud. I'm not entirely sure about Jason. I'm sure, knowing the guy, he was an absolute stud. So Jeff is the founder of I Am Wealth. He's a certified financial planner, one of my best friends and mentors. And it looks like, David, you might just get a full one-on-one session here. So that'd be amazing for you. And then Matt, the other gentleman on here, Matt is our go-to CPA for our clients. He focuses on helping medical practices with their taxes and also individual families. He currently works for about 50 practices and probably 175 total physicians. And Matt likes me to share on his behalf that he played poor college basketball, but he can still dunk. So just keep that in mind, although he rolled his ankle pretty bad a month ago. So I don't know if he can do that anymore. So the general flow, we're going to start with just a few kind of hot topic questions. And then Matt is going to jump into some actual case studies side by side using Jeff and I as examples. And then we'll have an example for live Q&A at the end of this.
What we could do, James,
sound good? Go ahead.
Is we can still do the initial Q&As, but we could realistically scrap the case studies and just say, hey, David be the case study if he felt comfortable with it. And we can go through a real life, test case with his numbers, right? Or the numbers he wants to use hypothetically.
I'd say 100% up to David and his comfort level. I see we have one other person here too, but we could also do a little mix of all of us if we want. It's totally up to you. No pressure, David.
I'm just here to learn.
Okay.
We'll do the case study. We have some stuff put together, so
totally
you can
understand.
Feel free to interrupt at any point in time too and ask questions, and I'm sure some stuff will come up.
All right.
Perfect. Cool. So jumping into kind of some hot topic type questions. Matt, what the kind of like, ask the expert, and we will have time at the end of this for Q&A as well. Hi, Vivian. I see you joining. Vivian's a new client member of I Am Wealth. Great to see you on here. She's just finished her training, so congrats to you. Shout out. So anyways, back to ask the expert. Matt, what are some of the most crucial mistakes you see 1099 physicians make as it relates to how they structure their business entity, or just being a 1099 in general, maybe deductions? What are some of those common mistakes that you typically see?
I'd say it's likely a matter of just taking your information at the end of the year, right? So typically, as a subcontracted physician, you get a 1099, right? And you might have a list of unreimbursed expenses that you have related to that 1099 work. You put together that information, you give it to either your CPA or TurboTax, whatever it may be, and then you get a product back. And what they're trying to do, especially in the height of busy season, they're trying to turn it around extremely quickly. So what often happens there is there's not a whole lot of, okay, James, Jeff, I see you have this list of expenses here, but what about XYZ, and fill in the blank? So one example being, as a 1099 physician, you qualify for what's called a qualified business income deduction, potentially. So as a service provider, that is also subject to a phase out, but this qualified business income deduction is 20% of your net income from your 1099 income, is a deduction right off the top. So one case that I had, this was for a new client, I think it was last year, it might have been 2 years ago, but they gave me their prior year tax return and said, hey, what do you think about this? Is there anything I could be doing differently? And I said, well, I got some good news and some bad news. The good news is you didn't pay as much in tax last year as you should have. The bad news is your income tax return is drastically wrong because they took this 20% business income deduction. As a physician, it is phased out if you make over a certain amount of money. So roughly 400 grand, we'll call it, that 20% deduction starts to phase out, or is finally phased out. So they were taking it as a qualified business. So non-physicians or non-service providers, non-professional service providers, they all just get the 20%, right? So we have a separate set of rules for physicians, for professional service providers. James, Jeff, you're subject to this. I'm subject to this limitation as well. Whereas if you have a normal manufacturing company down the road, they're not subject to this extra limitation. So not every CPA is going to understand and realize exactly how to treat professional service providers, I guess, in that situation. But there's, like I said, there's an unlimited amount of errors that you can have, and it really comes down to the conversation and the extra dialogue with your professional.
Awesome. Yeah, thank you for sharing that. I always think that's a really unique story. Any other mistakes? You want me to move on to the next question we talked about?
Oh, any other mistakes? There's a lot of other mistakes, but let's just move on to the next. We'll get into all kinds of mistakes once we get into the case study.
Okay, cool. What is something a listener, because I know it's so unique, right? Everybody's situation is different, whether you're married, whether your spouse has income, whether you're single, whether all the different things, right? What is something a listener could take away from today and just immediately implement into their life? Even if something as simple as just like, maybe a minor exercise or interview a CPA, or what comes to mind?
I would say the biggest thing is surround yourself with impactful relationships with other individuals that might not share your same skill set. So myself, I'm going to surround myself with other people that are not necessarily financially minded, but they have other creative strengths, right? I'm not a creative mind at all. So that piece definitely supplements me well. But in the case of a lot of physicians, they're not necessarily, and there's always exceptions, right? But a lot of physicians aren't necessarily as financially minded, so they might have a good partnership relationship with a CPA or an advisor, and maintaining those open lines of communication would be the number one thing. But if you have a good buddy that you can call on for questions, that's the name of the game right there. You can call them up. How many times, Jeff, do you call me on a monthly basis and just say, hey, what about this, Matt?
Probably too much, but
You didn't hear that from me. That's never too much.
Yeah.
Oh,
Yeah, it
that's funny.
sounds like I think the dialogue aspect is probably the number one, ingredient there in terms of the mistakes being made is because there's not enough dialogue about just kind of where we're at any point in the year, because things change in terms of income coming in, expenses going out, and then also the world around us changes, tax code changes, who's in, office changes, legislative things that have an effect on us in any 12-month cycle. So I think just having, from what I'm hearing from you, Matt, I think it makes sense to be in routine conversation with the people that we all know and trust.
Absolutely. And how
Yeah.
does that professional adequately provide support for you, right? If they don't really truly understand your situation and what questions are coming through and what business changes you might be approaching to.
Love it. And just
Definitely.
like all of us, and surround ourselves with a capable team of physicians, people like, in the healthcare world to take good care of us when we need help. I'm not going to YouTube like how to remove my gallbladder or something. And then what have you seen as the difference between a successful easy for me to say, successful professional relationship with a CPA or an advisor, or like what if some of your most successful physician clients, like what kind of things do they typically look for in their CPA team?
I think one of the main areas is not necessarily just having that open dialogue, but setting aside and protecting that time to connect. So one example is for some tax planning meetings, and it could even be just once a year at the end of the year, but not just the only time I talk to my CPA is during tax time, right? Because by that time, it's too late to make some significant changes on your 2024 return once we're sitting here looking at it in 2025, right? So protecting and setting aside some time at the tail end of the year, or even late summer, to connect with your professional and say, hey, here's what the situation looks like. What could I be doing differently, or what could I do to be prepared for the future?
I think a real cool question too to add in there for just for a little bit of extra transparency's sake, because there's certainly going to be a number of people that may listen to this or just out there in the world that do take a very kind of do it yourself, like hands-on approach, and so regardless of who's doing the work, whether it's somebody on the professional team or the individual, the client them slash the physician themselves, what is the data that needs to be looked at intermittently throughout the year? So if somebody's doing it themselves, what's most important to look at each quarter? Is it just looking at receipts, expenses, what's going on in, again, the world around us with tax code for that 12-month cycle? What's the data that needs to be looked at regardless of who's actually doing that work?
It would definitely be, so if you have a separate LLC for your 1099 income, your separate LLC's banking activity and or credit card activity would be the main thing, right? How much am I accumulating as far as income goes? And then ultimately, what are the tax ramifications of that? So if I have a net income of 300K, for example, what can I do to lower my tax liability? But also understanding how much that tax liability potentially is. Right. So making sure you're prepared, and then also taking action on what opportunities are out there to minimize that liability.
Yeah. Right. So
Sometimes we come across, and I'm sure you guys have seen this too, sometimes we come across situations where the business income, they don't even have an LLC. It's just commingled with a personal account. And expenses are commingled with personal accounts, and that can be a nightmare. And there's a lot of lost expenses on the table as well, when it's commingled like that.
Right, right. Yeah, I think it's I mean, we've been there too, and just in having that, drawing a line in between your business and personal banking. It just, that makes things easier to track, easier to make good decisions and get good insight quickly. Because if it's all in one big proverbial pot, it's kind of hard to make some of those decisions throughout the year because you're having to just add things up on the fly. So it sounds like just quarterly, taking a look at the cash flowing in and out of the business, as well as thinking through, like, just kind of forecasting what you would anticipate making and spending in the balance of the months ahead before December 31st. Just looking at the numbers so you can make good decisions throughout the year. Regardless of
And
who's looking at the data, right?
Yeah, and what do you need personally as well? Because obviously that's ultimately why we do what we do, right? We work to live, we don't live to work.
Yeah, absolutely.
Amen to that. Cool. You want to jump into some case study action now? Jeff and I will be the hypothetical guinea pigs.
Yeah. So, I mean, naturally, when we're on a 1099 basis, we're advised to set up a separate PLLC, right? A professional LLC. And at that point, we have the segregation between our personal world and our business world via this LLC. So the first recommendation would be, okay, let's either consult with an attorney, or let's, if we feel comfortable, maybe there's a good resource, maybe online resource that can help us provide those corporate documents to set up the LLC. That's not my world by any stretch of the imagination, but I know the IRS and, specifically maybe some patients might say, okay, well, in a malpractice situation, if you have an LLC, but you don't have the corporate documentation to say you're an LLC, they can do what's called piercing the corporate veil, and your LLC can be disregarded, and then they can attack you personally, right? So having that LLC is primary, first and foremost, the most important piece. But then, okay, now what do we do with the LLC? An LLC by nature, let's say hypothetically, James, you're a physician, right? And you work on a subcontracted basis and you accumulate 1099 earnings, and you're the only owner of this LLC. You're not in partnership with anyone else. This is just for your hard labor. This LLC is it's considered a single member LLC. And it's another word from a tax perspective is essentially a sole proprietor or a Schedule C on your individual income tax return or your 1040, right? There are pros and cons to being a Schedule C or a sole proprietor on your tax return, but you could also make a decision to say, okay, well, I personally like the structure of an S corporation. You could say, okay, IRS, and this is one simple form that you can file with the IRS within a certain number of days after the beginning of the year. You say, hey, IRS, I know I'm an LLC, a single member LLC, but I want to be taxed as an S corporation. The IRS responds and says, okay. I haven't never seen one rejected. I don't know if that's even a thing for them to reject those, but so now all of a sudden we have an S corporation, right? So we have two different worlds or two different buckets that we could potentially play with. We could stay an LLC or a Schedule C on our 1040, or we can go this S Corp route and potentially receive different pros and cons with an S corporation. So the way I think it would be good to analyze those two situations, right? I don't really ever see in this world or in this environment right now anyone looking at C corporations or any other tax format. So S Corp and Schedule C are the main two. But why don't we go through, maybe James, if we kind of pretend that, you know, you're a physician, right? And you're just starting out, we can have this interaction or this dialogue between the two of us to say, okay, based on a certain income, here's what a Schedule C or a sole proprietor situation looks like, and here's what an S corporation situation looks like, and we can go from there. Does that sound doable?
Sounds great. Let's do it.
All right, perfect. So how I would approach this is just say, okay, James, what do you anticipate earning on an annual basis?
Yeah. So in this year, you know, it's a little rough, a little hard to project. But I know for the sake of this scenario, I think I'm on pace to earn about 300,000 this year.
Okay. So you'll see, I just shared my screen here. This is my name, so not your name, James. Maybe I should change that for the
That's
sake
all
of the
right.
study.
It's all good.
But we have, on the left side of the screen here, we have Schedule C business. So this will be reported on your individual tax return. So this is my individual tax return. And I'm saying, okay, James earns 300 grand on an annual basis. Let's hypothetically, for this case study, say that he has no expenses, and that's ultimately going to be his net income, right? I'm going to hit our calculate button here. And this is
Matt,
going
are
to,
you able to zoom in at all? If not, no worries.
that's a good question. It's hard to see.
Yeah, I
Oh
can
no,
see it.
oh Davey, okay, cool. I just saw you kind of like lean up a little bit, so I wanted to make sure. Okay, we're good. Keep going.
Good to hear, because I don't really know how I would zoom in.
I
Okay.
I
see
don't
it
know if I've
fine.
zoomed in before.
No worries.
So in this case specifically, we have 300 grand as our Schedule C income. So if I move over to our Schedule C form, this is what it looks like. We have our collections, no expenses for this situation, and our net income of 300 grand. And that dovetails right into page 1 of the 1040. 300 grand here. And there's also, I'd mentioned earlier that as a business owner, you have this extra deduction, right? The qualified business income deduction. That is right here. And in this case, it's an extra 51 grand of a write-off, right? So ultimately, and I put together on this spreadsheet here what some different scenarios would look like. Okay, 300 grand as a married filing joint household. What does your total tax look like? And that's between income tax and Social Security, Medicare tax. And we got roughly 66 grand of total tax there. Okay. So if we change the situation and say we have the exact same scenario, it is a married filing joint situation. So it is a husband and wife, but only one of them is currently working. But we say, instead of this being a Schedule C, where it all 1099 income, it'll still be 1099, but let's say we made the election to be treated as an S corporation. We'll go over here and say, okay, I'm an S corporation now, but the IRS as an S corporation says you are now required to take a salary. So an S corporation has, you're just required to be an employee of your business. Even though you're the owner of the business, you're still required to be an employee. And they also take it a step further and say you're required to pay yourself a reasonable compensation. So let's just say hypothetically that reasonable compensation we split in the middle and call it 150 grand each. So 150 grand is left over at the end of the year on the S corporation as net income. That's after our compensation of another 150 grand. So we're still arriving at our same net income, right? If you add both together, of 300 grand. Following me so far, James?
Yes.
Oops, sorry, I was muted. Yes.
Perfect. So we're still in the exact same situation. We have 300 grand, but now instead of being on a Schedule C, we are now in an S corporation. And our tax software, we have to go down to this qualified service income area here to make sure they give us that extra 20% deduction.
Matt, do I have to like show proof that I actually like paid myself from like a business account to a personal account?
Yes.
Okay.
Yep. Yeah, and that's part of that piercing the corporate veil thing, right? So if we deposit any collections directly into our personal account, right, we're disregarding the LLC. So in a court of law, they're going to disregard that LLC as well.
Okay.
Not that I'm a lawyer or this at all is legal advice, because it's definitely not. Couldn't
Yep,
be the
I'm with you.
furthest thing from. But we're still in the same world of 300K of total income, right? But you'll see that this qualified business income deduction line item is now down to 30 grand instead of the, what was it, about 51?
Yep.
Yep, 51,670 before, and now it went down to 30 grand. Okay. So we're actually losing some benefit here, but what are potentially our benefits as an S corporation? So let's go through that. As an S corporation, you pay less in Social Security and Medicare tax because on the 150K of net income left over at the end of the year in an S corporation, you can take those as shareholder distributions instead of a payroll. Whereas on a Schedule C basis or a 1099 just on your individual income tax return, all of it gets hit with that Social Security and Medicare. So that went from, well, I'm up here. So that went from 29 grand in the first scenario down to 22,950 in the second scenario, the Social Security and Medicare piece. But you see that due to the loss of this qualified business income deduction, your income tax increased by 8 grand. So those more or less offset, but in an S corporation world, the income tax and Social Security and Medicare tax actually increased under an S corporation scenario.
Wow.
Taking that a step further, James, would you consider yourself more of a conservative individual when it comes to write-offs? Do you have kids at all that you could potentially employ within the organization, whether it be, marketing, advertising, something of that nature?
Do you want me to be hypothetical or real here?
You do whatever you want, man. I'm just going with the flow.
Open architecture. Well, yeah, so actually, yeah, we have a couple kids that I think could help out with marketing and advertising that I could employ.
Are you breaking the news?
Yeah, Steph is actually, no, I'm just kidding. I don't have a kid. I'm a man of integrity. I feel like I'm lying right now. But for this scenario, I thought it'd be more fun to play out if I did have kids.
For
so
sure.
let's pretend I do have kids, and I want to be more on the aggressive side, which both of these are like not truthful. I feel like for me as a human.
So there's a couple different line items we could discuss in more detail here. One being kids and potentially compensating kids, right? And we have to think of a reasonable basis for compensating those kids in the IRS's eyes. But if you were to hypothetically pay your children, let's just say there was some marketing material, you got them up on a website, you got them on some pictures on brochures, a hypothetical situation like that. Let's say you have 2 kids, we pay each of them 10 grand for the year. They don't actually see that money because you're managing it for them, right? So this $20,000, multiply that by, and let's go back to our tax return here. And let's look at what is our tax rate. So this marginal tax rate for this individual at 300K of AGI taxable income of 242 is 24%. You can actually add, we'll just call it 6% on the state, but we'll just keep it at 24 to keep it simple, especially if there's people in Florida. So we'll take this 20 grand times 0.24. Now all of a sudden that's 4,800 of potential tax savings, but for each individual child, they don't have to file a tax return if they make less than $12,000 in a year, right? And now all of a sudden they have earned income of 20 grand. We can now fund a Roth account for them and max that out every year. That's an after-tax account, even though it was never taxed. That's going to accumulate for those kids over a substantial number of years. You get the time value of money. And it was a free tax write-off for you. So that's a $4,800 benefit. And the reason I put this under the S Corp bucket isn't necessarily because when you're on a Schedule C, you can't have kids on the payroll. It's just naturally easier in an S corporation because of the fact that as an owner, you're required to be an employee. So we're required to add that payroll anyway. So there's an administrative cost to having payroll. We'll call it, $2,500 a year, right? So we're paying this payroll service $2,500 a year in an S corporation world, where in a 1099 world, that's a cost that would not exist unless we hired kids, right? And then another opportunity, I put rent here, that is not available in the Schedule C world, which is this one right here. It's only available in the S Corp world. Is, let's say hypothetically, you, James, you're a physician, you don't have an office, right?
Correct. Yes, I do not.
So how are you going to meet with, let's say it's another professional like myself, you're going to meet your CPA as opposed to going to their office, or you're meeting with someone else to talk business and you invite them over to your house, right? And let's just say that, per hour you charge from your business to yourself $200 an hour for that meeting space. And let's just say you rented it out for 20 hours for the year. $200 an hour at 20 hours is an extra $4,000. So this rent, and I'll put in parentheses here, like I said, does not exist in the 1099 world, or the Schedule C world, I should say, only in the S Corp world, because the IRS prohibits you from doing a self-rental. So when you're an S corporation, it removes the related party rules. So now all of a sudden we can pay ourselves a rent for our house. And not just that, and I put Augusta in parentheses because this rule was created at you guys are familiar with Augusta National, right? The golf course.
Totally.
Yeah, it's a very
So
a very special week for my kids and I to watch the golf tournament every year.
There you go. So there must have been some very connected individuals with some high net worth houses in the area of Augusta National that would rent out their house, if we even want to call it a house, and they would rent it out for 1 to 2 weeks. And it was a substantial tax burden to them, right? Because they would rent it out for a significant amount of money. Well, the IRS said, they called it the Augusta rule. They said, if you rent your house out for less than 2 weeks out of the year, you don't have to claim that as income. So now all of a sudden we have a situation where we are renting from our S corporation to our individual, ourself. We're renting it for meeting space. In this case, it was 20 hours at $200 an hour, $4,000. We write a check to ourselves or transfer the money to our personal account. We don't have to claim that as income on our individual return, and it's an expense to the S corporation. So now all of a sudden, if we drag this down, we have an extra $1,000 in this situation of additional tax savings. So James, at this point, how do you see your income growing or potentially staying the same even over future years?
Yeah, I think I'm a little, obviously being a new attending, I'm a little overwhelmed by my student loans. So I think, of course, the kids are still like pretty young, but I think next year, after I kind of get in the loop and the swing of things, I want to start picking up some extra shifts. And just hopefully, so I want to shoot to make about 400 next year. And I think ERG said my hourly rate might go up too. Don't get me in trouble, anybody out there.
This is being recorded, right? You might get yourself into trouble, James.
I'm just kidding. Sorry, Michelle.
Yeah, so in that case, if hypothetically we were saying you're earning 300 grand a year and your income is static, there's really no opportunity for much significant growth. With this gap being, the S Corp world being slightly more expensive when it comes to total tax, income tax, Social Security, and Medicare tax, an extra $2,000, plus you have to pay the extra $2,000 of administrative costs to have payroll, right? That's going to roughly offset the benefit of doing some of these more, what I would call aggressive tax savings techniques, to where if you're making 300 grand and you're going to be staying static at about 300, it's probably not worth the extra effort to go through the process of filing for an S corporation, right? But the situation can change dramatically if, for example, we make 400 and our spouse also has earned income. So we created these couple rows here for analysis on if your spouse even just earns a modest amount. This qualified business income deduction was the main reason why the total tax or the income tax piece was more in the S corporation situation than in the 1099 situation. If our spouse earns income here, that qualified business income deduction starts to go away. So now you'll see, in this case, as a 300K physician earnings, that QBI goes down to $5,000 here in the S Corp. It goes down to 35K, so it's a drop of about 16K when you make 300. It goes away completely once you hit that 400K mark, right? So now all of a sudden, it creates a situation where moving over to an S corporation is not that burdensome. So if I'm making 400K and I elect to be treated as an S corporation, I'm losing a deduction of 30 grand. You see the difference there, James? This QBI, yes, or that 20% deduction, we lose 30 grand of a deduction. But if now I have a spouse that is also earning a decent living, our QBI was already eliminated. Even on a Schedule C, we no longer have that deduction. So we're not really losing.
Is that because of the phase out? Sorry to cut you off.
Correct. Yep.
Okay.
So if your household taxable income is over this 400K number, it gets eliminated completely.
Okay. Got it.
So now all of a sudden we're in a situation where if we do decide to switch to an S corporation, we don't lose the QBI anymore, but we gain the benefit of lower Social Security and Medicare tax, drops by about $9,000 here. And we also get the benefit of the extra tax savings opportunities that we discussed earlier, right? So now our total tax in a 400K earnings with a spouse that has earned income as well dropped by $6,000, call it $5,000, $5,400 here. So it dropped by $5,400, plus it could drop by this amount as well, another $5,700. So now all of a sudden we have 11 grand of tax savings in this situation by switching to an S corporation. So as you can see, the more you make, the higher amount of tax savings you can potentially have by being an S corporation. But the less you make, it could also be a significant burden to you to switch to an S corporation. You have higher tax here, plus you have the administrative burden of payroll and an extra tax return too. That was something I didn't mention earlier. An S corporation, you have to file a separate business tax return, which will cost you another $1,000, $1,500. So that being said, James, if I'm giving you a recommendation for this year with you having roughly 300K of earnings, I would recommend to stay put and reassess once your situation is more like 400, to then evaluate these tax opportunities and say, okay, does it make sense now to switch to an S corporation, especially if, you know, potentially your spouse is working too.
Yeah. Quick question. What if I stay put, choose the Schedule C route? Could I still, I know you said it's a little bit more of a logistical nightmare. Could I still employ my kids if I wanted to in that Schedule C world and take that deduction?
It wouldn't necessarily be a logistical nightmare. You just have the additional administrative cost of payroll, just the payroll expense. So we'll call it $2,500 a year of costs to have payroll software. And I mean, that's obviously a rough estimate, but that's a $2,500 cost that didn't exist before. So you just want to make sure. And, you know, in this case specifically, if you're paying your kids 20 grand, you're saving $4,800, right? So that payroll cost of 2,500 is less than our tax savings of 4,800. You know, you could look at that and say, okay, it's worth it. To some people it is. To some people, they don't want to go through the extra work to justify paying kids, and realizing also that the IRS, depending on what agent you get, might say, okay, what is the business purpose for this, and going through, you know, the process of that too.
Okay, I see. So, and do the kids have to work a certain number of hours? Or does it just have to be justified and rationalized?
Justified and rationalized. It's hard to put a value on. I mean, you guys are familiar with the sports world too. So you start to use the words name, image, and likeness, right? So it's hard to put a value on those things. And so you would have to prove it for sure. So here's what we did during the year, and here's the result of it.
Okay, I see. Okay, that makes total sense. Cool.
You know, if the child was doing more of a labor intensive work for you, let's just say they're cleaning something or driving you around, I don't know what it would be, but then you would have to say, okay, for this role specifically, an hourly rate would be X, and that therefore that's why we paid them X, right?
Okay, I see. That makes sense. Okay, cool. And then do we have is it one last scenario that we're looking at, or do we get through all of those on the?
I think we got through all of them. Yeah, I think that pretty well summarized, especially for your specific situation, right? Starting at 300, building up to 400, and then potentially if you have spouse earnings as well, how that would change the situation.
Okay, that makes sense. Okay, thanks so much, Matt. You're the
Unless
man.
do you guys want me to elaborate on that?
I have a question.
Yeah, go ahead, Jeff.
I would say, let's just say so this is a question about how to know when it's time to restructure, and like, let's just pretend somebody on here takes leave. Somebody goes on maternity leave for a series of months, and so their 1099 production goes down in a given year. So maybe they were at 300 in 2023, but in 2024, there's a new addition to the family, and so they go on leave. Their 1099 production's down, and maybe last year it made sense to do an S corp, and maybe this year it makes sense to change that based on production. And how often would you see people just going through, whether it's just production based or also changes to tax code? How often do you see people changing that election? Is that something to look at? One of the entity decisions to
Extremely
make kind
rare
of.
and extremely difficult to do something like that. So once you make the S election, you're pretty much married to it until
Okay,
you're done. I mean, it is possible, but it's not something you'd want to juggle or could juggle back and forth.
okay, okay.
Interesting.
I was just wondering what that looked like, if it's something like, check the box this year, we're filing this way, or we're filing that way, or we're
No,
structured
it's a
this way or that
permanent
way.
election with the IRS.
Okay,
You'd have to have a special request to get them to revoke your S status.
okay, okay, interesting. Thank you for that.
Can you pull the Excel spreadsheet up one more time, Matt? For me, please. I was gonna see, okay, so okay, never mind. We did go through all the different scenarios. I was thinking for whatever reason we missed out on one. So do you see, I guess, do you see a lot of physicians? Because it sounds like the S Corp is great. Like there can be opportunities, obviously, where you save, like in the example where you said about 10 grand a year. It does seem like it's, there's more obviously logistics involved. Once you do it, you never go back type deal. So do you typically see a lot of physicians elect the S Corp, or is there typical, like sometimes some hesitancy because like once you do it, you can't, like what we just talked about?
Yeah, I mean, honestly, it's probably half and half.
Okay.
Half the people see these opportunities as very enticing, and half the people are like, well, there's a lot to be said about keeping it simple, right? Or keeping it basic. Simplicity and peace of mind and knowing exactly what I have. That's hard to put a value on too, right? So having an extra tax return, having payroll, having all these things, it might be more advantageous. Hey, you might get 10 grand a year of less taxes, but maybe that's not worth it to you, right? It really depends on the individual at that point.
Okay, that makes sense. And are there certain other, which I know we're going to probably cover in the next one, certain other like deductions or more creative things that you can do within an S corp that you can't do in an LLC, or can you typically do like the Augusta rule, for example? You don't need to go super in the weeds with all of it because that's what the whole next class will be about.
The Augusta rule is the biggest one I can think of. Retirement plans are another one that can change based on your entity structure. And just the contribution amounts, just hypothetically, if we were sitting at 300 grand on a Schedule C and we made the switch to being an S corporation, now we have a 150 of a W-2 and 150 of net income on the S corporation. Our contribution to a SEP, for example, would be based on our W-2 income, as opposed to when we were a Schedule C, it was based off the 300. So now all of a sudden we went from 300 down to 150. And how does that change our retirement contributions? So that's another piece that could change based on structure.
Okay, I see. Interesting. Okay, cool.
Right.
Do we want to open it up for Q&A or anything else, Jeff or Matt, that you guys want to ask or share?
Yeah, I think one thing that I would ask too is like in that scenario, and then I'll get out of the way with the interjection of questions. But if in that scenario, you see people using solo 401ks as a workaround for decreasing their net income as a business, to say like we can still make a much larger contribution inside of a solo K than inside of a SEP, based on that net income reduction.
No, absolutely. Yeah, because you have the employer's contribution and the employee side, and you get it right off the top, not just strictly based on net income.
Right. But that again comes down to looking at the right numbers throughout the year, especially as you're making those entity setup decisions. That would be just another one of those questions to ask, is how can we shelter as much of the earnings as we possibly can into a retirement account. Cool.
Yeah. And another piece too that we didn't get into, based on what state I'm earning income in. There's certain states that allow you to pay income tax through the business, and what it does is it creates a deduction on your federal income tax return So if hypothetically, and I know Georgia is one of those states, but let's just say we have 300 grand of income times 6%, and now we can pay that 18 grand, which is what that amounts to. Now we can pay that 18 grand at the business level instead of through our personal income taxes. So we multiply that by our 24% income tax rate that we had earlier. That's an extra $4,300 tax savings based on, where I'm earning my income. So that's another one too that I want to say about half states have. It's called a flow through entity or pass through entity deduction. But that's another tool.
Matt, can you remind me for the physicians on here, because I know they're typically in Florida and Georgia with ERG. How do they know which, would it be the headquarters of ERG? Is it the physical location that they're driving to work? Like, how do they decipher which, or does it depend which state they're earning income from?
Physical location and residency. So physical location being, okay, I went to a hospital in Georgia, that's taxable in Georgia, right? And then it dovetails back into the residency of the state. So if I earn, in my case, let's say I earned money in Georgia and we're going to remove Florida just because they don't have income tax, so that it wouldn't apply to Florida residents. But let's say I lived in Michigan and worked in Georgia, your income would be taxed first in Georgia, and then it would be taxed again in Michigan with a credit on the Michigan return to lower your Michigan tax. So it would say income taxed in another state or credit for taxes paid to another state, and that would be a reduction of Michigan income tax. But essentially, long story short, where you earn the income.
Okay, that makes sense. Let's open it up for Q&A, and if no one has any questions, Jeff and I can keep going. I can still come up with things. Anybody here have a question that they'd like to ask the wizard, Matt?
Yeah, right.
Hey guys, a great presentation. Just a question regarding when to actually do an S Corp versus just saying sole proprietorship. I have a side gig where I make 1099 income. I already have a W-2 job. So my side gig only makes like 70K, pretty good, decent amount, but didn't seem right to do an S Corp to avoid, the sort of the taxes on salary or whatnot. What do you find is the sort of breaking point to say, oh, if you make 150K that's the breaking point to where you should go S Corp? Or I mean, I know it's sort of nebulous, but is there sort of an income range for your 1099 income to ditch the sole proprietorship and do S Corp?
That's a good question. I want to say it is that range of 300 to 400K. And in your situation specifically, so if we have 70K on a 1099, we have roughly 150 on a W-2 already. Your Social Security and Medicare taxes are going to be paid through that W-2 earnings. Your 70 grand is not going to have a whole lot of extra taxes on it, because the Social Security wage base, let's call it 165, you're only going to have, 15K of your Schedule C income that's going to have Social Security taxes on it. So switching to an S Corp in that situation is not it'll only save you, Medicare taxes of 1.45%. So definitely wouldn't be worth it, even if you do get the extra benefits of the Augusta rule and that sort of thing. I still don't think it would be worth it in that case. But I typically say rule of thumb 300 to 400 is worth looking in detail at, and then that's of course when the other circumstances of spousal earnings and those types of things come into play too.
Yeah, and I think also what we see people doing that have that kind of supplemental income is, and I don't know if this is the case for you, Ricky, but maybe where we generally see it is that we've got a large W-2, and they're maxing out a retirement plan through that employer plan with the W-2 arrangement, but then also with 1099, we try to drive that AGI down, that earned income down as much as possible and shelter that income into a solo 401k. That would just kind of be another number crunching, like puzzle to solve. But is that usually what we see is it's locums work. People are picking up extra shifts, 1099. Is it clinical 1099 or is it non-clinical?
Not clinical. So more paid surveys and speaking on pharmaceutical drugs.
Right.
Yeah.
Yeah. Do you have with your other income? Is there a retirement plan you're already contributing to?
Yeah. So I max out my 403b at work. And so I have a sort of customized solo 401k. I just did it for this year as well for my 1099
Awesome.
income.
Perfect.
So what's going to happen is I have the solo 401k that I can defer about 20% of the income from the 1099, but then also do post-tax contributions and then do the mega backdoor Roth. Unfortunately, my 403b at my W-2 gig sort of eats into that, so which is sort of just the stupid quirk, I guess. But whatever. But so that's what I was going to be doing for the first time this year, the mega backdoor Roth with my 1099 income. But then I had been talking to other accountants, and one had proposed that you could also do a defined benefit plan, and when you fall behind on the defined benefit plan, you can actually make a loss for your business. So I don't know if you guys have encountered that, but I had somebody propose that defined benefit plan for my 1099 income and declare. Apparently, it's very hard to keep up sometimes, and so if you can't keep up with the payments of it, you can declare it as a loss. I don't know if you guys have an experience of that for 1099 income.
Right. Yeah. That's probably another scenario where you ask yourself, after looking at all the facts, is the juice worth the squeeze on that? And sometimes it is, right? That's but it sounds like you're doing a lot of awesome stuff already, Ricky, for sure. Doing the right things, trying to do what you can with that 1099.
Oh, it's because I talked with James before.
There you go.
Hey, Ricky.
Nice.
Hey, James, you're looking good, man. Yeah. So
you too, my friend. Thanks for being here.
thanks.
Cool. Yeah, and I think also we'll dig into more of those crafty deductions next time as well, for some of the things we didn't talk about today. Other creative, one of the things that we see that's really popular on the deduction side to drive down some of that income might be like you as a family leasing your vehicle, not only leasing your home to the business to have a business expense that's driving some of that income down, but leasing a vehicle that you own. So there's sorry, I'll try not to go on a tangent with it, but we'll be diving into some of those lesser known missed opportunities next time on July 10th. But I'll stop and then open up for other questions here too.
I had a question as well. So I'm Chrissy's director. I just had a quick question about location, like what you decide to be like your permanent address or where your office space is. I'm just currently commuting to work, so live in like one city and then kind of commute, drive back and forth. Is there anything you can do or anything you can recommend with 1099 versus S Corp for things like expenses with travel, like renting a hotel or getting a hotel or renting a spot, or just mileage, gas, hotel? Like, is there any big difference there between the two?
Say necessarily between the two. Both rules as far as travel should be the same. The biggest piece is, do you work at multiple hospitals, Christina, or?
No, just in Jacksonville.
Okay. So the challenge in that case is the IRS has a rule, and it's called commuting expenses, right? So if you work for only one location, your technically you're commuting from home to that one location, are non-deductible travel expenses. So oftentimes what I'll try to encourage is for people to work at multiple locations. And when you work at multiple locations, you can, the one you work primarily at is your commuting location or your home location. And then any travel to any other location is deductible travel expenses. So that one's a challenge to try to
Would
not.
that be in the same city? Like, if you're working at like 2 freestandings and a main in the same, St. Augustine versus, downtown Jacksonville versus, is that considered all one location or different locations?
Nope, different locations.
Okay, so then
It
you
goes by
could,
number of miles to your main
Okay.
location. And then as long as your commute is greater than the number of miles to your main location, that would be deductible expenses.
okay, how many miles have to be from the main?
It doesn't make a difference.
Oh, it doesn't. Okay.
No. Yeah, and in some cases, there's certain individuals, let's say they can work remotely and they might go into the hospital once a week or a couple times a month or whatever that may be. They can actually claim their commuting expenses or their main office location as their house. So every time they leave their house, now it's travel, right? And there's a lot of different things when, whether it's reading labs or, there's an infinite number of areas where you're not necessarily required to be physically present, right? So that's another area too where I see certain people qualify for.
Okay. Because I feel like with 1099, it seemed like there was a lot more like standard deduction versus like the S Corp. So I thought maybe there was something there with travel and commuting.
No, you might be thinking of the business use of home rules. So business use of home, there is a standard deduction for that one.
Okay.
To where you don't have to like accumulate all of your utilities and property taxes, mortgage interest, all those items. The IRS just gives you a flat like $1,500 a year to write off.
Any other questions from everyone? And also, just so everyone knows, it's 1:09, just in case anyone has to be anywhere. Time flies. We're having so much fun. Any other? I can stay for a few more minutes. Jeff, Matt, I don't know if you got to go, but any other?
I do have to jet.
Okay.
I have to be back at home. I ordered a massage for my wife for Mother's Day, and it starts at 2, so I do have to get out of here. But
all right, you better
Great
run.
work.
Matt, real quick, for anyone listening that's here, also this will be on YouTube, so we'll let people on the internet listen to it too. Where can anyone find you if they want like a free consult? Because you're just a wealth of knowledge.
I don't know about all that, but I would love to connect with anyone. My email is matt.barczak@rehmann.com, REHMANN. And Barczak is spelled on the screen here, but it's BARCZAK.
Okay. Awesome. Cool. And yeah, Matt has done a ton of incredible work for a lot of our clients. So thank you all for being here. This was awesome. We'll see you guys July 10th, and we'll probably have Michelle send out the invitation for that starting tomorrow or at the very latest 4th of July week. And if you can't make them, we'll get you the recordings. And if there's any other topics that you want us to cover in the future, just email journey@iamwealth.com. Journey, like you're taking a journey of the band. And then we'll can create some like custom topics for ERG.
Bye.
And others, of course. All right. See you
Meet
guys.
you guys.
Thank you so much.
Thanks, Matt.
You, James, Jeff.
Thank
Thank
you,
you.
Matt. You're the man. See you guys.
Bye.
I Am Wealth does not offer individual financial advice outside of a formal consulting agreement. Content discussed in the I Am Masterclass is not and does not represent financial advice, tax advice, and or legal advice. The intent of the I Am Masterclass is to provide extremely valuable financial educational content for free. For personal questions, we hope that you'll visit iamwealth.com and schedule what we call a free financial wellness diagnostic to assess the current state of your financial health and therefore help you and your family take control of their money so they can live a more meaningful life. So we'll see you there. I Am Wealth does not